What if I told you there's an institution more powerful than your government, more influential than any corporation, that manipulates the value of every dollar you earn and every debt you owe, and you probably couldn't name a single person who runs it? Central banks operate in the shadows of the modern economy, controlling the money system through monetary policy that sounds boring and technical, but is actually the mechanism keeping you perpetually poor while the financial elite get richer with every policy decision. These aren't conspiracy theories. These are documented functions of institutions like the Federal Reserve, the European Central Bank, and every other central bank controlling the debt system you're trapped in. Here's how the con works. Central banks don't just print money and manage interest rates randomly. Every policy decision they make serves one primary function: ensuring that debt keeps expanding, that credit keeps flowing, that the banking system keeps extracting wealth from your labor. When they lower interest rates, you think they're trying to help the economy, but what they're really doing is making debt cheaper, so you'll borrow more. When they print trillions through quantitative easing during a financial crisis, you think they're saving the economy, but what they're actually doing is bailing out banks while inflating away your purchasing power. And when they raise rates to fight inflation, you think they're protecting you, but they're actually triggering recessions that wipe out middle-class wealth, while the financial elite buy crashed assets at discount prices. The cost of living doesn't rise by accident. The wealth gap doesn't widen by chance. Economic inequality isn't a natural phenomenon. It's manufactured through monetary policy designed to benefit those who own assets and control credit while punishing those who work for wages and carry debt. And if you stay with me, I'm going to expose exactly how central banks orchestrate this wealth transfer, why perpetual debt is their explicit goal rather than an unfortunate side effect, and what you need to understand about their playbook before the next economic crisis wipes out whatever wealth you've managed to build. Ready to see who's really running the show? Let's expose the most powerful institutions you've been trained to ignore. Let's start with what central banks actually do. Stripped of the technical jargon designed to make you think it's too complex for regular people to understand. At their core, central banks have one primary tool. They control the cost of borrowing money by setting interest rates and influencing the money supply. When they lower interest rates, loans become cheaper, which encourages individuals, businesses, and governments to borrow more, expanding the total debt in the system. When they raise interest rates, borrowing becomes more expensive, which theoretically slows down debt growth. But here's the trap. In a debt-based monetary system where all money is created through loans, the economy requires constantly expanding debt just to function. If debt stops growing, the economy collapses. Central banks know this, which is why their policies always circle back to one goal: keep debt growing. The Sabio Observer sees the pattern clearly. Central banks respond to every economic problem with the same solution: make credit cheaper and more available. Economic slowdown? Lower rates to encourage borrowing. Financial crisis? Print trillions to inject liquidity into banks so they can lend more. Asset prices falling? Keep rates low to inflate stock markets and real estate, making people feel wealthier so they'll borrow and spend more. This isn't bad policy execution, it's the deliberate design. The system requires perpetual debt expansion, because without it, the mathematical impossibility we discussed earlier, debt always exceeds money supply, causes immediate systemic collapse. So central banks act as the debt machine's chief engineers, constantly adjusting the levers to ensure credit keeps flowing and debt keeps growing. But here's where it gets truly insidious. This perpetual debt expansion creates winners and losers by design, and you're engineered to be on the losing side. When central banks lower interest rates, who benefits? People who already own assets, real estate, stocks, businesses, because those asset prices inflate. The financial elite who own most assets see their wealth multiply. But what happens to you, the wage earner? Your savings account earns nothing because rates are near zero. Your cost of living rises because cheap credit inflates prices, and you're encouraged to take on debt, a mortgage, car loans, credit cards, because money is cheap. You become a debtor while they become wealthier asset owners. When central banks eventually raise rates to slow things down, your debt gets more expensive to service. Recession risk increases, threatening your job. But the wealthy who bought assets with cheap credit are fine because they locked in low rates. Every policy cycle transfers wealth upward, and central banks orchestrate it all while claiming they're managing the economy for everyone's benefit. This isn't a side effect, it's the operating system. And it gets even worse when you see how they manufacture crises. Now let's talk about something that sounds like conspiracy theory until you look at the historical pattern. Central banks don't just respond to financial crises. They create the conditions that make crises inevitable, then use those crises to expand their power and transfer more wealth to the banking system. Look at any major economic crisis in the past century and you'll find the same playbook. Years of cheap credit inflating bubbles, followed by sudden tightening that pops those bubbles, followed by massive bailouts and money printing that saves the system while wiping out middle-class wealth. The 2008 financial crisis is the perfect example, and understanding what really happened reveals the central bank con game. In the years leading up to 2008, the Federal Reserve kept interest rates extremely low after the dot-com crash, making mortgages incredibly cheap. This encouraged a housing bubble, as people borrowed massive amounts to buy overpriced real estate. Banks created exotic debt instruments to multiply their profits, and everyone assumed prices would rise forever. But here's what most people miss. Central banks knew this was unsustainable. They had the data, the models, the insight, yet they kept rates low year after year, inflating the bubble bigger and bigger. Then, when the bubble was at its peak, they started raising rates. Suddenly, all those adjustable rate mortgages got more expensive. People couldn't pay. Foreclosures cascaded, and the entire banking system teetered on collapse. Crisis manufactured, whether intentionally or through willful negligence. But watch what happened next. This is where the real game reveals itself. Central banks stepped in as saviors, printing trillions through quantitative easing, bailing out the banks that created the crisis, buying up toxic assets to save financial institutions while millions of regular people lost their homes, their savings, their futures. The wealth gap exploded after 2008 because central bank policy saved asset owners and destroyed wage earners. And what did they get in return for saving the system? More power, more control, more ability to manipulate markets through unlimited money printing that became the new normal. Every crisis follows this pattern. Cheap credit creates bubble pops destroying middle-class wealth. Central banks print money to bail out the financial elite, and their power to control the economic system expands. They're not incompetent. They're executing a playbook that's worked for over a century, and the next crisis is being engineered right now through the same mechanism. Here's the final piece of the central bank con that affects you every single day. Inflation isn't a natural economic phenomenon. It's a deliberate policy tool that functions as a hidden tax on your wealth, while making debt easier to manage for those who understand the game. When central banks print money, whether physically or digitally through expanding bank reserves, they increase the money supply. More money chasing the same goods and services means prices rise. That's inflation. Your dollar today buys less than it did yesterday, and tomorrow it'll buy even less. This is the cost of living rising, and it's not an accident. It's monetary policy working exactly as designed. But here's the trap within the trap. Inflation has opposite effects, depending on whether you're a debtor or a creditor, whether you own assets or just earn wages. If you have a $300,000 mortgage at a fixed rate, inflation actually helps you because you're paying back the bank with dollars that are worth less than when you borrowed them. Sounds good, right? Except here's the catch. Wages rarely keep pace with real inflation, so your purchasing power decreases faster than your debt gets easier to pay. You're on a treadmill that speeds up while you're running. Meanwhile, people who own real assets, land, property, businesses, stocks, see those assets increase in nominal value because of inflation. The financial elite who understand this deliberately take on cheap debt to buy assets, then let inflation make their debt easier to pay while their assets appreciate. They use central bank policy to get rich while you use it to survive. And central banks know this wealth transfer is happening. It's the point. They target 2% inflation officially, but real inflation, food, housing, healthcare, education, runs much higher. This constant erosion of purchasing power keeps you working harder, keeps you needing credit, keeps you trapped in the debt system. You can never get ahead because the finish line moves away from you at the same speed you're running toward it. Every time you think you're making progress, getting a raise, saving some money, paying down debt, monetary policy adjusts to maintain the extraction. The banking system needs you in debt, needs you borrowing, needs you struggling, because that's how interest flows upward. Central banks are the enforcers of this system, using technical language and complex policy to hide what is essentially organized wealth extraction. And the scariest part? The next phase of their control is already rolling out through digital currencies that will give them even more power to monitor, control, and manipulate every transaction you make. The debt trap is tightening, and central banks are turning the screws while telling you it's for your own good. So now you see it clearly. Central banks aren't neutral institutions managing the economy for everyone's benefit. They're the architects and enforcers of a debt system designed to transfer wealth from those who work to those who own, from wage earners to asset holders, from the many to the few. Every policy decision, interest rate changes, quantitative easing, inflation targeting, serves this function while being disguised as technical economic management. The cost of living rises, the wealth gap expands, economic inequality deepens, and they tell you it's all necessary to maintain stability, while they engineer the very instability that consolidates their control. The question now becomes, are you going to keep participating in this system blindly, accepting central bank policy as inevitable economic reality, borrowing when they make credit cheap and suffering when they make it expensive? Or are you going to understand their playbook well enough to position yourself on the winning side? Because while you can't change central bank policy, you can absolutely change how you respond to it. You can stop thinking like a wage earner and debtor and start thinking like an asset owner and creditor. You can recognize when they're inflating bubbles and position yourself accordingly. You can understand that inflation is coming and hold assets that preserve value rather than cash that loses it. Here's what I want you to do this week. Track one central bank decision, an interest rate change, a policy announcement, anything. Then trace the actual effects. Who benefits? Who loses? Don't listen to what they say it's supposed to do. Watch what it actually does to wealth distribution. Follow the money. See the transfer happening in real time. That exercise will teach you more about how the economic system really works than any economics course, because you'll see the machinery operating rather than the propaganda explaining it. And if this video exposed how central banks orchestrate the debt trap that keeps you poor, if you now see monetary policy as a wealth extraction tool rather than economic management, subscribe to this channel and turn on notifications, because the next video goes even deeper. I'm going to show you exactly how to position yourself like the financial elite do, how to use central bank policy cycles to your advantage rather than your detriment, and specific strategies for building real wealth in a system designed to keep you in perpetual debt. Central banks won't stop engineering your poverty, but you can stop cooperating with their plan.